All right, let's talk about the market in 2026. It really feels like a minefield out there, right? So, what if I told you there's this elite group of companies that are so incredibly reliable, they've been increasing their payouts to investors not just for years, but for over half a century? Today, we're diving into the kings of consistent cash. So, this is the big question we're all trying to answer, isn't it? Growth stocks feel like a total roller coaster, and just holding cash means you're losing money every day. So where do you go? Where can you find some stability, some income? Well, that's the puzzle we're here to solve. And yeah, this number right here is a huge part of the problem. Even with interest rates finally starting to cool down a bit, inflation is just sticky. It's hanging around at 2.74%, and that's like this silent thief, just constantly eating away at your buying power. Any investment strategy you have has to clear this hurdle just to break even. Now, this is our benchmark. This is what you can get from a 10-year treasury bond, pretty much considered the safest investment on the planet. So any stock you're considering for income has to compete with this. It needs to offer a better deal, not just by beating this number, but crucially by having the potential to grow that income, to keep fighting off that inflation we just talked about. And that brings us to these guys, the dividend royalty. Look, these are not just companies that happen to pay a dividend. Think of them more like financial fortresses. They are the all-weather anchors that have proven time and again they can handle pretty much any economic storm you throw at them. So let's break this down. There are kind of two tiers to this royal family. First, you've got the Dividend Aristocrats. These are the blue bloods, big quality companies in the S&P 500 that have raised their dividend for at least 25 straight years. But then you have the Dividend Kings. These are the absolute monarchs. They have an unbelievable 50-plus year streak of dividend growth. That is the ultimate test of endurance. And what's really interesting is how the rules shape these lists. You see, for the aristocrats, you have to be in the S&P 500. That means they're all going to be these huge, well-known companies. The kings, though, no index requirement. It is a pure, raw test of a company's ability to survive and thrive for half a century, which means you get some smaller but incredibly tough businesses on that list. Okay, so this whole history of raising dividends, it's not just some nice trivia for your next cocktail party. No, it translates into real tangible performance, especially when things get ugly in the market. Let's see how these companies actually hold up when everyone else is panicking. Let's go back to the 2008 financial crisis. I mean, one of the worst market meltdowns ever. The S&P 500 got crushed, down a staggering 38%. But the Dividend Aristocrats, they only fell 22%. Now that 16-point difference, that is a massive, massive cushion that helps you keep your capital when you need it most. And hey, this wasn't just a one-time thing. Let's fast forward to the crazy volatility of 2022. The S&P 500 was down over 18%. The Aristocrats, barely down 6%. So you see this pattern, right? They consistently provide this downside protection. It's a core part of why they're so attractive. We can actually measure this stability. There's a metric called beta. A beta of 1 just means a stock moves exactly with the market. Well, the beta for this group is 0.79. In plain English, that means they are about 21% less volatile than the overall market. So when the market is on a wild roller coaster, these stocks tend to take a much, much smoother ride. But, and this is a really important but, it's not a magic shield. It's not foolproof. To really get this strategy, we have to look at when it breaks down, because even kings can be dethroned, and the lessons we learn from their fall are absolutely critical for any investor. I mean, take 3M. This was a company with an incredible 60-year streak of raising its dividend. It seemed completely untouchable. But then it got hit with what analysts call tail risk, basically a worst-case scenario. Billions and billions of dollars in legal settlements. These massive, unforeseen costs just became too much to handle, and that legendary dividend had to be cut. Now, the story of Leggett & Platt is a little different, but it's just as important. Their 52-year reign didn't end with a sudden shock like 3M's. For them, it was a slow, grinding decline in their main business. The weak housing market just crushed their earnings year after year until there was simply no other choice. They had to slash their dividend by a painful 89%. And this quote, wow, it just says it all, doesn't it? When a company breaks that sacred promise of a growing dividend that investors have counted on for decades, confidence just shatters. The stock price for Leggett & Platt absolutely tanked, proving that the market's reaction to something like this is swift and it is brutal.
So let's just break it down here. For 3M, a big warning sign was that their growth was already stagnating, even before the big legal problems hit. For Leggett & Platt, it was that steady drip, drip, drip of falling earnings per share. The lesson here is so clear. You can't just look at the long streak. You have to look at the health of the underlying business today.
Okay, so we've seen the power of this strategy, but we also know the potential pitfalls. So how can you actually use this information? How do you apply this to your own portfolio here in 2026? Let's get into the actual playbook. For most people, honestly, an ETF is the simplest way to get exposure. Here are 3 of the big ones. Noble is for the purists. It only holds the official aristocrats. VIG is a bit broader. It looks for companies with at least 10 years of dividend growth. And then there's SCHD, which is really for people who want higher income right now. It focuses on high-yield stocks that also have strong fundamentals. Your choice really just depends on what you're after: exclusivity, broader diversification, or immediate cash flow. Now, if you're gonna go out and pick individual stocks yourself, here's a quick mental checklist. First, make sure you're not overpaying. Check the PE ratio. Second, you want to see strong recent earnings growth, and this one is so important. Check the payout ratio. That's just the percentage of its profits the company is paying out as a dividend. If it's under 80%, that's generally a good sign it's sustainable. Companies like Medtronic, Federal Realty, and Caterpillar are pretty good examples of what this looks like right now. And that really brings us to the final thought here. These companies, they aren't the ones you see in the flashy headlines. They're usually in what most people would call boring industries: utilities, consumer staples, industrial parts. But as we've seen today, in a market that's filled with uncertainty, that kind of boring consistency, that stability, and those growing cash payments, well, that might just be the most beautiful thing an investor can find.